Hi guys, today we will analyze Zion's Bancorporation. As it's clear from the name, this company operates in the banking sector. It's a fairly large company with several subsidiaries operating in different states, namely Zion's Bank, the largest bank in the company, operating in Utah, Wyoming, and Idaho, California Bank Trust, MEG Bank, operating in Texas, National Bank of Arizona, Nevada State Bank, Vectra Bank, operating in Colorado and New Mexico, the Commerce Bank, operating in Washington. As is common for banks, their primary revenue comes from issuing loans on various kinds, including consumer loans, mortgage, and small businesses loans. The company diversifies its assets well. It allocated 72% to loans, 26% to securities, and the remaining 4% to cash. Their loan portfolio is well diversified, with low delinquency rate and high margins compared to industry standards. One of the biggest risks for any bank is interest rate risk. Zion's Bancorporation manages this risk using various financial instruments like swaps, forwards, options, etc. At the moment, I haven't found information on how big their affiliates are relative to their competitors, but as of 1999, I have found this information. Zion's Bank ranked second in Utah and ninth in Idaho with a market share of 18% and 2% respectively. California Bank and Trust ranked 6th in market size in California with a 2% market share. Nevada State Bank ranked 3rd in Nevada with a 12% market share. Vectra Bank ranked 5th in Colorado with a 3% market share. The Commerce Bank of Washington ranked 12th with 1% market share. This is what the map of their banks looked like at the time of 2007. As you can see, the company had 508 branches at the time of 2007, and it was its policy of lending and risk diversification that helped it survive the 2008 crisis and even expand some of its markets, because in 2008 they already had 513 branches. I think it was already clear from the previous maps which banks from this company are influential. But just in case, there is a next picture that shows it all. But it doesn't mean that the year 2008 did not affect the company in any way, because the price of its share at that moment was falling by almost 90%. I like the fact that the company during the period of 2008, namely the worst year in history for all banks, correctly reacted to the situation and reduced from 43 to 32 cents in dividends per share, instead of further paying them to shareholders and driving the company deeper into debt. Let's now move on to the financial performance of this business. I was impressed that the company retained its net income up to pre-pandemic levels, indicating that its dividends are likely safe. Total assets also increased, suggesting that the bank is not stagnant. Total liabilities, as noted earlier, are within the normal range for the bank, indicating manageable debt. The company is also actively buying back its shares, which is good news for its shareholders. I rate this business a 4 out of 10 because the bank is relatively small and its brand is not widely recognized. The smaller and less well-known a bank is, the fewer people will trust it with their money. This means the company will need to work hard to earn the trust of its clients, whether through better loan or deposit conditions or easier access to its services. Remember, a bank deals with finances, and the more risks it takes on, the more money it should make. While Zion's Bank manages close to 90 billions in assets and likely carefully diversifies its risks, as indicated in its reports, this strategy helped it survive the 2008 and 2020 crisis and even expand its market share over the decade. However, until it invests in its brands, it will struggle to grow its business. My opinion is supported by the price of its shares, which fluctuate around the same level, despite the company paying solid dividends of around 4% and having a remarkable PE ratio of around 9. I believe there are many other great opportunities even in the banking sector to invest money. Another indicator supporting my view is a comparison of the company's overall revenue to the S&P 500 index. As seen, the company performs well, but not as well as one I would like to invest money. If you are looking for a company that pays good dividends and want to be sure that it will continue to pay them, this is your choice, as I think a company with such an approach will not go bankrupt in the near future. However, keep in mind that this is all the company can offer you right now, as I believe the company is trading at a fair price and I don't expect its assets price to increase in the near future. Nevertheless, it's not a bad investment that can bring profit through solid dividends, moderate company growth, and gradual share buybacks from the market, leading to an increase in its price and the ability to increase dividends in the future. But in my opinion, you can find a business with more potential, as the only thing that sets the company apart from other banks is its risk approach, its unique feature and strategy. But unfortunately, such an approach, although providing stable positive results, is not something unique that I would like to buy. If you liked my video, please like and subscribe to my channel to not miss future videos where I will continue to explore other companies.